Okay, picture this. You take a crisp 10,000 rupee note, you invest it just once, and then you completely forget about it. You go about your life, and years later, you look back, and that single 10,000 rupee investment has quietly morphed into lakhs. It sounds crazy, right? But welcome to today's explainer, where we're unpacking the infinite harvest, mastering the art of compound interest. We're going to fundamentally shift how you look at wealth creation today, moving past the basic stuff and getting right into the actual mechanics of how capital scales over a lifetime. So often, we're fed this narrative that building wealth is just an endless grind. You know the drill. Work harder, clock more hours, take huge risks, or just get really, really lucky. But honestly, the reality of capital is entirely different. The real goal here is to shift from active income to passive capital efficiency. I mean, what if your money actually went to work for you? Imagine it earns a little bit, and then that new money clocks in and goes to work too. It's about setting up a system where your money does the heavy lifting, working, earning, duplicating, so you don't have to sweat for every single rupee. So if the secret sauce isn't breaking your back or perfectly timing the stock market, what is it? Well, it's actually just time. Think of it like planting a seed. You provide the initial soil, you give it a little water, but you can't physically force it to grow faster, right? Time is this silent, persistent engine driving the expansion. Building real wealth isn't a frantic day-to-day sprint, it's an exercise in patience. It's letting the fundamental laws of math do their thing over decades. All right, let's dive right into section 1, the mechanics of the magic, simple versus compound interest. You know, a lot of people assume successful investing is all about picking the perfect stock or trading at the exact right millisecond. But the real lever of wealth, it's the mechanism of your return. We're talking about compound interest. Basically, this means you earn interest on your original money plus all the interest that money has already generated. With simple interest, you only ever earn on your starting amount. But compounding, that's when your gains start producing their own gains. It creates this amazing, self-sustaining ecosystem of growth. And this perfectly illustrates exactly what I mean. Look at that straight line on the left. That's simple interest. It stacks predictably, just a flat, linear trajectory. It's basic addition. But then look at the curve on the right. That is compound growth. Because your interest is compounding on previous interest, it eventually breaks away from that flat path and just explodes exponentially. That upward inflection point, right where the curve suddenly accelerates and climbs almost vertically, that right there is where generational wealth is born. Okay, I know. The scary formula. Finance bros love to make this look incredibly intimidating. But honestly, the most critical part of this equation isn't the principal amount, and it isn't even the interest rate. It's that little exponent right up there, the T for time. When you strip away all the financial anxiety, the truth of this equation is actually pretty elegant. The longer your capital stays invested, the more aggressive that exponential curve becomes. Time is literally the multiplier that turns ordinary savings into extraordinary wealth. To really see this in action, just look at this 20-year breakdown. It perfectly highlights the biggest behavioral trap in investing. So a flat, simple growth model just plods along, right? But check out the compound column. In those early years, like years 1 through 5, the difference is totally marginal. It's almost unnoticeable. And that is exactly why so many people get bored and abandon their investments early. But jump down to year 15, 18, 20, the compound growth completely decouples from the simple model. It ends up massively higher. Pushing through those boring early years absolutely pays off in that late stage acceleration. Which brings us to section 2, the tortoise and the hare, a tale of two investors. Let's look at a really practical example. We've got two friends here. First, there's Rahul. He starts early, at age 20, putting away 5,000 rupees a month. He does this for exactly 10 years, and then at age 30, he completely stops. No more contributions, he just locks it in. Now his friend Aman decides to wait. He finally starts at age 30, right when Rahul stops. Aman invests that exact same amount, 5,000 rupees a month, but he does it for 3 straight decades until he's 60. So Rahul invested for just 1 decade. Aman invested for 3. So, here's the big question. Guess who ends up with more money at retirement? Seriously, think about it for a second. Our brains are hardwired to think linearly, right? So it feels incredibly obvious that Aben should win this. I mean, he put in way more capital, put in way more effort, and kept it up for an extra 20 years. So who actually walks away with the bigger portfolio? No way around it, the winner is actually Rahul. Despite Aman investing for 3 times as long and dumping in way more of his own cash, Rahul had a fundamental law of finance on his side. Time is greater than timing. That extra decade Rahul's money spent compounding and multiplying in the background completely overshadowed 30 years of Aman's delayed contributions. It just goes to show, starting early drastically beats trying to catch up later. The length of time you are exposed to the market is the absolute ultimate variable. Now, what's really interesting is Section 3, the ultimate finance shortcut, the Rule of 72. I want you to literally lock this number into your brain right now, 72. This is the coolest, quickest little shortcut in finance. Whether you're looking at a market return, checking out a savings account, or figuring out inflation, this rule tells you exactly how long it takes for your money to double itself. Forget building complex spreadsheets. This gives you immediate clarity on how fast your capital is moving. The math here is super simple. You just take the number 72 and divide it by your expected annual interest rate. So say you're getting an 8% return. 72 divided by 8 is 9. That means your money is going to double roughly every 9 years. 10,000 becomes 20,000. 9 years later, it's 40,000. Then 80,000. It's amazing. You can instantly see why leaving cash in an account paying 2% is such a missed opportunity compared to, say, an index fund paying 8%. Which leads us perfectly into Section 4, the cost of waiting. Start planting today. The whole framework really boils down to this. Start early, stay consistent, and just let time do the heavy lifting. I know one of the biggest psychological hurdles is thinking, well, I don't have a massive amount of cash right now, so why bother? But listen, the rupees you invest today are vastly more powerful than the rupees you invest tomorrow. The starting amount matters way less than the discipline to just begin. Consistency builds the foundation, and time scales the whole shebang. The richest investors aren't always the smartest. They just started earlier. I absolutely love that quote. Building wealth really doesn't require you to be some financial genius glued to a spreadsheet trying to time the bottom of the market. It relies almost entirely on having the discipline to simply leave your investments alone and not interrupt the compounding process. Being smart might earn you an extra percent here or there, but starting a decade early, that literally multiplies your entire portfolio. At the end of the day, compound interest just equals time plus patience. It's a remarkably powerful force, but it desperately needs room to breathe. This is absolutely not a get-rich-quick scheme. It is, however, an inevitable wealth strategy if you just leave it undisturbed. The math is literally guaranteed to work, as long as you don't panic when the market hiccups and you give that geometric curve enough runway to hit its stride. So we've seen the math, we've seen the insane advantage of just starting early. The true seed of wealth is undeniably time in the market. So the only question left for you is every single day you delay, how much future wealth are you quietly erasing? Don't be the hare trying to desperately play catch up later in life. Start planting today. Thanks so much for hanging out with me for this explainer, and I'll catch you next time.